Wall Street plays a pivotal role in influencing corporate finance, serving as both a barometer and a driver of economic activity. At its core, the relationship between Wall Street and corporate America is deeply interconnected, with each influencing the other in ways that either can accelerate growth or trigger setbacks. Wall Street's origins date back to the mid-1600s, when Dutch settlers in New York built a wooden wall to defend themselves from the British and Native American forces. Though the wall was taken down in 1699, the name stuck, and the area eventually became a bustling center of trade. The street's financial importance was cemented in 1792, when 24 of the most prominent brokers and merchants signed the Buttonwood Agreement under a buttonwood tree on Wall Street. They set the foundation for what would later become the New York Stock Exchange, trading war bonds and stocks from institutions like the Bank of New York. Over time, this agreement grew into the powerhouse that is now the New York Stock Exchange. By 1817, brokers had officially renamed themselves the New York Stock and Exchange Board. By 1865, they had found their perennial home at the corner of Wall and Broad Streets, marking the beginning of Wall Street's reign as the global financial center. Over the decades, additional stock exchanges such as New York Mercantile Exchange and the American Stock Exchange further solidified the area as the heart of financial activity. Wall Street isn't just an economic powerhouse, it's a cultural symbol. Its fast-paced lifestyle has been depicted in iconic films like Wall Street, Margin Call, and Boiler Room, which dramatize the intensity, wealth, and at times ruthlessness associated with it. These depictions have cemented Wall Street in the public imagination as a place of wealth, power, and intrigue. Beyond the silver screen, Wall Street has also produced real-life celebrity figures. People like Warren Buffett, Jamie Dimon, and George Soros are not only known for their financial acumen, but for their influence on society at large. Their names evoke the elite circles of finance, where fortunes are made and decisions affect millions. The famous Wall Street district in New York City represents more than just a physical location. It symbolizes the financial heartbeat of the U.S. and the world. Home to the New York Stock Exchange and other major financial institutions, Wall Street drives the investment landscape and helps to fuel the U.S. economy. Talking about the role of stock markets. The New York Stock Exchange and the NASDAQ are two of the largest stock exchanges globally, where trillions of dollars worth of shares change hands. Stocks represent ownership in companies, and by trading on these exchanges, investors can buy and sell shares, providing companies with the capital they need to grow. The stock market is a reflection of investor sentiment about the future. When investors are optimistic, stock prices rise, encouraging businesses to expand, hire, and innovate. Conversely, when investors lose confidence, stock prices fall, and this can lead to a more cautious economic environment. Financial markets, more than just stocks. While stock trading often grabs the headlines, Wall Street deals with a much broader range of financial instruments that influence various sectors of the U.S. economy. From bonds to commodities and foreign exchanges, these markets are integral in keeping the economy running smoothly. Bonds are the key tool for both the U.S. government and corporations to borrow money. When the government issues bonds, it essentially takes loans from investors, promising to pay them back with interest. The yield or interest rate on these bonds has a significant influence on the economy, as it affects everything from mortgage rates to credit card interest. Commodities markets. Wall Street also plays a vital role in the pricing of essential goods like oil, gold, and agricultural products. These commodity markets allow investors to buy and sell contracts based on the future price of these goods, which in turn impacts their real-world prices. Through the trading of bonds, commodities, and other financial instruments, Wall Street exerts a broad and far-reaching influence on the U.S. economy, shaping interest rates, inflation, and the cost of living for everyday Americans. Corporate America, the Wall Street connection. Wall Street's influence extends deeply into corporate America, where financial markets provide businesses with capital they need to grow, innovate, and create jobs. By issuing stocks and bonds, companies can raise money to invest in research, development, and expansion, all of which are essential for economic growth. Initial public offerings, IPOs. An IPO marks the moment when a private company goes public by offering its shares to the public on the stock exchange. For many companies, this is a critical turning point as it allows them to raise enormous amounts of capital, which can be used to fund new projects or expand into new markets. Mergers and acquisitions. Wall Street is also central to mergers and acquisitions, where companies buy out or merge with other firms. These deals are often financed by capital markets, and they can reshape entire industries by consolidating companies or introducing innovations. Through IPOs, mergers, and other financial tools, Wall Street provides the lifeblood of capital that allows American companies to compete and thrive in the global market. Impact on employment and wages. While Wall Street's influence on the broader economy is undeniable, its effects are most keenly felt in the job market. When companies are financially strong and growing, they hire more workers and pay higher wages. Conversely, when the market faces downturns, businesses often reduce their workforces or freeze wages. Job creation and expansion. When a company experiences rising stock prices or gains access to new capital through bonds, it often translates into job creation. Businesses invest in new technology, open new locations, and expand their workforces, contributing to the overall economic growth. Recession and layoffs. However, when Wall Street faces a downturn such as a financial crash of 2008, it can have disastrous consequences for the job market. A bear market or prolonged decline in stock prices often leads businesses to scale back operations, resulting in layoffs and reduced consumer spending. The health of Wall Street directly influences the availability of jobs and the strength of wages in the American economy. A booming market often leads to increased prosperity, while a bust can cause widespread economic hardship. The wealth gap. Who really benefits from Wall Street? While Wall Street's influence on the U.S. economy is immense, not everyone benefits equally. One of the most pressing issues today is the growing wealth gap. As the financial markets tend to favor those who are already wealthy, leaving behind many average Americans. Wealthy investors versus everyday American. Wealthy individuals and institutional investors such as hedge funds and pension funds have the resources to invest heavily in the stock market and benefit from its growth. However, many average Americans do not have significant stock holdings, and therefore they don't reap the same rewards from Wall Street's gains. Retirement and investment accounts. Still, it's important to note that millions of Americans do benefit from Wall Street through their retirement accounts such as 401ks and IRAs. These accounts are often invested in stocks and bonds, meaning that a strong market can improve retirement savings. The relationship between Wall Street and wealth distribution remains a complex issue. While financial markets play a critical role in economic growth, they often contribute to widening the gap between the wealthy and everyone else. The future of Wall Street. Challenges and innovations. Looking ahead, Wall Street faces both challenges and opportunities. Regulatory changes, technological advances, and shifting public sentiment will all play a role in shaping the future of the financial markets. Technological disruption. Emerging technologies such as blockchain and cryptocurrency are already beginning to disrupt the traditional financial markets. These innovations could lead to more decentralized and democratized financial system, where individuals have greater control over their investments. Regulatory pressure. In recent years, there's been growing pressure for increased regulation of Wall Street, particularly in the wake of the 2008 financial crisis. Policymakers are considering reforms that could limit risky trading practices and create a more stable financial system. Wall Street's influence on the U.S. economy is likely to continue for the foreseeable future, but it will need to adapt to new challenges and opportunities in an evolving financial landscape. Wall Street doesn't just reflect the economy, it actively drives corporate decisions. The sheer size of the U.S. stock market is staggering, with a gross domestic product of nearly $23 trillion in 2021, and a market capitalization that stands about 230% of the gross domestic product. This makes the U.S. the world's largest economy and gives Wall Street immense influence over businesses of all sizes. Investors ranging from massive financial institutions to individual traders can fuel business growth by injecting capital into the market. This happens through various types of investments, including sector-specific funds or broad market indices. When businesses use this capital efficiently, they can grow, expand, and innovate. At the same time, investors benefit from their returns on their investments, which can also help them hedge against economic factors like inflation. However, Wall Street's impact on corporate finance isn't always positive. Stock prices are highly sensitive to news, whether it comes from a company's executives or is reported in the media. Positive developments often lead to a bull market, where stock prices rise steadily, creating a wealth effect that boosts consumer confidence. This cycle encourages companies to expand, acquire assets, or even buy other businesses, which further stimulates the economy. On the flip side, negative news can trigger a downward spiral. A severe stock market decline or crash results in lower wealth for both businesses and investors. This in turn reduces consumer confidence and makes it harder for companies, especially smaller ones, to secure funding. Prolonged downturns known as bear markets can stifle growth, slow hiring, and put the brakes on expansion plans. There's a feedback loop between Wall Street and corporate leaders, especially when it comes to big moves like acquisitions or IPOs. When a company is preparing for one of these significant events, Wall Street amplifies the attention it gives to that business. This amplification effect can generate either positive or negative speculation, depending on the nature of the news. If the outlook is negative, it can lead to heavy selling, which puts downward pressure on both the acquiring company's stock and the stock of the company being acquired. Although the stock market isn't the real economy, it's a vital system for raising capital through share issuance, mergers, and acquisition. Business leaders keep a close eye on how the market reacts to their decisions. Financial analysts also play a crucial role by providing investors with performance reports and projections for individual companies, including metrics